Good afternoon and welcome to our Market Outlook webinar, recapping 2020 and looking ahead to 2021 and beyond. My name is Anthony Palmer, Group Commercial Director heading up products and investments for Carrick. Here to help us understand what has transpired and what to expect going forward is the highly experienced Rob Enslin, co-founder and portfolio manager of StrategiQ, who run local and international investment solutions for Carrick, and who were at our side and our clients' sides as 2020 played out. What an emotional roller coaster ride it has been. Normal life was replaced with social distancing, home working, homeschooling, and lockdowns. We saw panic selling, sharp recoveries, and unprecedented and coordinated central bank intervention at a speed and on a scale never before seen. After all was said and done, the markets ended 2020 with strong returns across the board, and I'm proud to say that our Carrick solutions had a fantastic year on an absolute and a relative basis. Rob, thanks again for joining us today. I think a perfect starting point is how you saw the markets unfold and what you think going forward.
Good afternoon, Ant, and thank you for all the listeners for taking the time to be with us today. I think the topic of today's presentation, to kick things off, is really recover, reset, and grow as a theme. And certainly that's the common consensus in the market at the moment, and certainly something that we will be going with. So what I'd like to take you through today in the presentation is to firstly look at what happened in 2020, then fast forward to today and understand exactly what is taking place, and then take a little bit more of a forward view as to what to expect in 2021 and what are some of the themes that are likely to shape markets. So to get things started, I think at the start of 2020, we certainly knew that we were going to face some significant event risks. Things like Brexit, the US elections were all very much front of mind. And then just to remind all the listeners, at the start of the year, we kicked off with geopolitical tensions between the US and Iran. And that certainly felt as though that was going to set the tone between particularly Trump's trade negotiations in his final term. How wrong we were, because obviously COVID-19 took or dominated markets over that period. But nevertheless, it was certainly a significant year from an events risk perspective. That being said, though, the final scoreboard suggests a fantastic year for investors. And regardless of what asset classes you look at, there was a decent outcome for most investors who stayed put throughout that period. So for many of the listeners on the call, you will see a chart in front of you. And with that, really the only sort of sector or asset class that underperformed was commodities, really led by the energy stocks. But outside of that, really above average returns achieved by most asset classes. So if we take a final scoreboard and really unpack what the year looked like, and if we start off with the S&P 500, markets generally peaked across the globe around late January, late February in 2020. And thereafter, we saw, as we've expressed many times, the sharp sell-off in markets. So, for example, the S&P 500 was down 32% in a matter of 3 weeks. Since then, the market has actually gone on to rebound 63% and is now trading at a 10% premium or new high compared to that January-February high. Likewise, if one takes a look at the Nasdaq, which has obviously been in focus, that's had a tremendous recovery, rebounding 87% and is now 24% above its previous high. Maybe worth pointing out on this chart is the European region, particularly the FTSE 100, as well as the stocks, Euro stocks. They've probably underwhelmed compared to the rest of the market, but nevertheless have also recovered, but still some time to go to get back to their previous highs. Although markets generally performed well, there were certainly within that some winners and losers. And what some of the key standout performers have been is what we refer to as the stay-at-home type stocks or business models. So certainly winners within that have been the likes of your technology businesses. For example, within the MSCI World, they returned 48% over the year. And then on the flip side of that, sectors that were more aligned to the real economy and business activity, although achieved good returns in absolute terms, relatively speaking, underperformed the rest of the market. So things like staples returning 24%. So certainly been a fantastic year over the board, but within that there is some detail to unpack.
Rob, if I can interject at the moment, information technology, the tech shares have had a really great run. We get asked this question on a daily basis from clients. Is there room still to grow? Are the markets too frothy and overvalued? Your view on that would be appreciated.
Yeah. So I think if you look at the market valuation as a standalone and compare it to the past, it would be quite hard to say that it's not expensive. It's certainly on a historic basis, the market does look somewhat expensive. However, we do need to be a little bit more balanced in that view and understand relative to where interest rates and the amount of stimulus that is in the market at the moment, what valuations look like. And on that basis, they probably look a little less expensive. And equally, I think it's important for listeners to understand that tech has almost grown and that we see tech in two phases, almost old tech and new tech. So certainly some of these new tech business models, the likes of the Zooms, etc., share prices have run way beyond what their current earnings is, we would argue do look outright expensive. But in a sense, your old tech, your Microsofts of the world, earnings are very much still aligned to their share prices and aren't ridiculously expensive. So we almost break tech into old and new world, and I think there's still opportunity within that.
Okay.
And I think just for the listeners, just a little bit of fun and kind of gives a sense of really what happened in 2020. The perfect trade in hindsight, if one were to have gone long or bought the likes of your online retailers and gone short your traditional malls, that trade would have achieved a return of just shy of 200% throughout 2020. So certainly just gives you a sense of where the mood of the market is, and in a way accelerated some of those trends that were already slowly playing out in markets in prior years. We tend to focus on equities as the market in general, but I think it's also important at this stage just to understand that it was not only a good year for equities, it was a fantastic year for fixed income. And I think very seldomly you'll find yourself in a position that across the sort of dimensions of fixed income, whether it be duration or credit quality, you achieved a superb return. But at the end of it, it was really the best outcome was to take as much risk within the fixed income side of things. So long duration, high yielding debt achieved the highest return. But I think it will be hard to find a year where all the subsectors have achieved this type of return. And then just also important for clients to understand, if we rewind markets back to October 2018 and compare the performance of fixed income relative to equity, at this point in time, or by the end of the year, fixed income was still actually outperforming equities. I thought that was very interesting to take note of.
If I can again jump in here, Rob, on the ground, people are seeing the stock markets flying. But reality is a very, very different story. People are losing jobs, businesses are closing, there's no growth. How do you reconcile that disconnect?
Yeah. So there's certainly a big disconnect between economic numbers that are coming out from countries and earnings or companies' share prices in particular. And I think we must understand that generally, or not generally, certainly stock markets price forward. So they price future expectations into their valuations and discount those future earnings back to today. So whilst the current environment that we're going through as a result of COVID-19 has certainly been a tough 2020, earnings are almost looking 2, 3, 4 years out, and therefore that's why we're seeing this disconnect. And I think the challenge as the investment community is to ensure that those expectations going forward are realistic, and obviously we have to continuously measure new information, new risks that come to the market, and ensure that those earning expectations are still reliable in that regard.
Okay.
I'm going to turn the presentation a little bit more to the macro side of things now, just to have a better understanding of what's happening in terms of the real economies, etc. So if we look at growth expectations and we're relying on the IMF's expectations, what is different to perhaps a traditional economic cycle in that the globe tends to slow down, followed by a gradual recovery, is COVID-19 has created quite a sharp cut in business activity, and at the same token, the expectation is quite a sharp rebound. So that is a little different in terms of a normal economic cycle. So if we look at the chart that I have up, you can see for 2020, the expectation, the world is expected to contract by 4.4%. Emerging markets relatively stronger than developed markets, and I think China has a big input into that number. We now know the data. China was really the only major economy to show real growth or positive growth in 2020. certainly. But I think what's really in our numbers and our expectation is that 2021 will be a far better, stronger year for the globe. So rebounding from a really low base, the expectation is that the world will grow by 5.2%, led higher by emerging markets growing by 6%, and followed by advanced economies at about 3.9%. Secondly, we also need to understand that whilst maybe prices on the stock market and valuations are stretched, there is a highly accommodative environment at play. So starting off with the fiscal side of things, or from the government-led side of things, governments across the globe are quite prepared to get through this COVID-19 and almost first pay the money down, create a lot of debt, and then pay it off over time. So if we look, for example, at budget deficits at a percentage of GDP, regardless of what country we're discussing, there's been a big expansion there, or far ahead of what we would have anticipated at the start of the year. And similarly, in terms of spending on COVID-19, we've seen governments' balance sheets balloon. So at the moment, we're obviously waiting for the US fiscal plan to come through at 1.9 trillion. Assuming that comes through, they will probably be, as a percentage, a bigger spend than Japan. But Japan at the moment, for example, 21% of COVID-19 spending relative to the GDP has taken place. So that's a lot of support from governments. And then similarly, if we look at central banks, we know even in our own economy, we've cut interest rates to record lows. That same sort of phenomenon has happened across the globe. And what is quite key to understand, and we've used this chart a few times, is that the Fed have said to us that they are going to be accommodative for some time to come. And really the dynamics that they need are firstly for unemployment to be below 4%, and at the same time an average unemployment, not absolute unemployment. And at the same time, inflation needs to be on average above 2%. And if we go back in history and try and take those two dynamics and when have they played out in the past, it's only happened in the last 50 years twice before, which is really saying to us that we have a very accommodative runway in the US, and I think that will certainly lead other major economies around the world. With everything, there needs to be a release valve, and at the moment, what seems to be a big release valve has been the trade-weighted dollar. The dollar has certainly weakened relative to other currencies, both developed currencies as well as emerging market currencies. And historically speaking, that tends to be a nice underpin for emerging markets. The dollar is counter-cyclical to emerging markets, and there are some other favorable dynamics in play for emerging markets, relatively more attractive valuations, and the belief of higher commodity prices because of these fiscal programs that countries are running, propping up those commodity prices, are all nice underpins for emerging markets. So we wouldn't be surprised that if in 2021 and in the medium future, emerging markets outperform developed markets.
Robert, is the dollar expected to continue this sort of consensus view? I guess is that it is going to continue to weaken, but with all this money and all the stimulus that's being pumped into the system, is it still your view that the dollar is going to continue the trend of weakening?
Yeah. So I think we need to jog our minds back a little bit and go back to 2008, the financial crisis, and at the same time the US went upon the same type of program, pumping a lot of money into the system. And back then the expectation was that the dollar would also weaken, and if anything, the opposite has happened over the last decade. The dollar's been on a secular bull run for the last 10 years and only recently unwound that trade. I think what ended up happening was that because the US moved first, the economy was almost out of the blocks a little bit faster, and on a relative basis was a bit stronger than the other major developed markets. And as a result, their interest rates were slightly higher. So anyone searching yield on a relative basis, the US looked a little bit more attractive. That supply-demand dynamic led to an attraction towards the dollar and a strengthening of the dollar. That being said, that relatively higher interest rate in the US is not present in markets right now. So in terms of you comparing to the UK, Europe, Asia, and the US, that spread is narrowed. And I think that spread compression means that if it stays in place, the dollar is likely to continue weakening. It's a very difficult call to make, but that would be our view at this point in time. Okay. With all of that, I've created quite a positive picture for the markets, and it's always important just to see things through two lenses. And the one fact, or a few factors just to point out, is that the market is certainly complacent at this point in time. and looking at it through some different measures. So firstly, looking at US savings rates, you can see just how quickly Americans shored up some cash as COVID-19 broke in early March, April last year. And since then, completely unwound that trade. So if you go back over the last 30 years, it's certainly still at elevated levels, but the speed at which they've started spending again is something to point out. And similarly, a nice proxy to understand the mood of the markets in terms of opening economies and going back to normal is looking at the banking stocks. Banking stocks rely on higher interest rates as well as economic activity. And there's been a big recovery if we're looking at US banking stocks in recent months, suggesting that the market has become a little bit more comfortable and do believe that the future is probably brighter than what it's been over the last year or so. Similarly, if we look at volatility, so both bond volatility and equity market volatility, that has come off sharply, particularly the bond market. The bond market is actually at record lows. Equity levels of volatility is still elevated, but not what we were seeing sort of in March, April, May last year. And then we made this point earlier, but if we look at a CAPE ratio, so for many of the listeners not familiar with that, rather than looking at a P, it's a price divided by earnings in 1 year earnings, you take the 10 last year's average earnings to just kind of take the cyclicality out of it. And based on that, it's quite hard to argue that the market is cheap. It's looking somewhat expensive. But just to kind of balance that argument like I made earlier, you do need to look at it relative to interest rates. So the chart on the right-hand side with the red line shows you that, yes, on a CAPE ratio, it's expensive, but also we haven't really seen interest rates at these levels in the past. And then just another point to make here is that there's obviously optimism about a vaccine, and that is really that reset, rebound, regrow type principle in the markets right now. But in the last month, we have seen some variants, particularly the UK variant and more recently the South African and the Brazilian. To date, most of the vaccine providers have suggested that they are still able to deal with the variants, but what would be quite a shock and derail the whole recovery would be a variant that no longer vaccines are able to deal with. So certainly, it's not a base case, but just something to be aware of and think about in the markets right now.
Yeah, I suppose it's really, really great to see those cases coming down. Really fantastic news. But besides new variants as a potential headwind, what else are you seeing? What keeps you up at night?
Yeah. So the number one risk that derails this whole thesis of accommodative environments and stimulus is inflation, because ultimately inflation will lead to higher interest rates, forcing central banks to hike those interest rates, bond yields pricing up, and that really will pull the carpet out of cheap money, essentially, and unwind this. Certainly not our base case, by no means, but it would be a major threat should it play out in time to come. And I think really, if we're looking ahead, I've actually jotted that down as a key risk, so surprise inflation. Some of the other sort of things to keep abreast of or think about in the markets is firstly a vaccine-led recovery. That is the common expectation, that vaccines will be successful, particularly in the second half of the year, and that will lead to behavior or consumer behavior going back to normal, and with it growth. But that also has its own permutations. The rollout of vaccines, does it take place as fast as we expected? How does the dissemination of vaccines across countries work? Does that create this distortion between economies and social tensions in that regard? So there's a lot of unanswered questions there that we still need to watch. Thirdly, we are in a new sort of leadership regime. We are a Biden-led presidency in the US. We talk about a blue wave. How does that affect markets going forward? And then finally, ESG, or like we prefer to refer to it, is impact investing. Certainly been accelerated as a result of COVID. And how does that impact investment decisions going forward? So with that, I'm really going to unpack one or two of these factors with a little bit more detail. So starting off with the vaccine-led recovery, as it stands right now, we have 2 vaccines that are approved in the world. We've got the Pfizer vaccine, as well as the Moderna vaccine. And then there are 8 other vaccines that are allowed to be used in emergency measures. So, for example, the AstraZeneca vaccine, like South Africa received yesterday, is still considered an emergency vaccine. However, what is important to understand is that based on the past, when a vaccine trial gets to phase 3, there's a 78% probability that it will actually be approved. And as it stands right now, there are 20 vaccines that are in that phase 3. So assuming those odds are still at play, we're talking around 15 new providers coming on stream in the next 3 to 6 months. And that certainly will go a long way to flattening that curve and also improving behavior of consumers. What has also been quite interesting is listening to the surveys. So 6 months ago, a lot of people were negative or weren't prepared to take a vaccine. But slowly but surely, those surveys are suggesting more and more people are comfortable with taking a vaccine. Secondly, we touched on that COVID-19 variant. If you're looking on the left-hand side from the World Health Organization, that is just the study of that first approved vaccine from Pfizer, and it does show that it works. So really what in that trial, and it's only the first dose, remembering the Pfizer vaccine relies on 2 doses, 4 to 12 weeks apart. But some people received the placebo and others received the actual dose. And you can see the blue line in terms of cases, how widely that flattened. And that's really what we're trying to do with a vaccine. And then countries, although it's been a bit of a slow start in terms of rolling vaccines out, we are starting to see programs roll out across the world. And I think there are 58 countries at present that are actually vaccinating their population, with more to come, obviously, in coming weeks. Secondly, a Biden-led presidency. So we have a blue wave in place, and for the listeners who don't know what that means, it really means that we have a Democrat president, and at the same time, the Democrats have control of both the House of Representatives and the Senate. And essentially, that just means decision-making can take place a little bit easier. So once, if they propose anything, it doesn't get blocked either at the House of Representatives or worse so at the Senate. Often we have a divided Senate where the US may be a Republican or Democrat-led government, but on the flip side, the opposite is in control of the Senate. And the big one for markets right now is Biden has proposed a $1.9 trillion fiscal stimulus package for the market. That is still sort of hitting some headwinds, but getting a little bit close, and certainly would be a big injection of capital into the US economy, which should filter through to asset prices. Maybe also just worthwhile taking a step back and understanding the difference, what's really between the Trump-led government and now the Biden-led government. So on taxes, certainly the Republicans had a far more friendly tax approach. Biden's approach towards taxing corporates as well as the wealthy are certainly going to be more aggressive, or he's communicated that they will be more aggressive. Secondly, a lot more about regulation in terms of controlling energy, technology, etc. So all else equal, that would be some headwinds for the technology and energy sector. I think foreign policy, Trump was all about America, America first, where Biden will look for bilateral agreements and try and patch up some of the damage that is done during the Trump administration. But I think what is also worth mentioning is that we're not likely to see an environment where China and the US make up and kiss and make up. They've been quite clear about the fact that they're going to continue to put pressure on the Chinese in terms of trade relationships on the global front. And then just also worth mentioning, we had a phenomenal year in 2020 from a market performance perspective. And with that, it's quite natural for the listeners to expect, well, given the strength of what's happened, and like you mentioned, economy is not necessarily doing as well, are we going to see a market crash? I've been asked that question quite a few times. I'm certainly not going to try and predict a market crash or not, but what I can rely on is past data. If we look at the S&P 500, based on the last sort of 70 years odd, when we have an economic expansion in play, the odds of the market producing a decent return in that year is certainly in favor in terms of being positive. So 87% of the time the markets have gone on to produce a return that is positive, with only 4% of the time a negative return of below 10%. The expectation is an economic expansion. Should that play out, the odds suggest that we could very well see another good year in 2021. And then just finally, ESG. So ESG certainly, or environmental, social, and governance investing and principles. We prefer to call it impact investing. And really what that means is, in the past, when looking at an investment decision, we were first just looking at return. Over the years, that return moved towards return divided by the amount of risk you're taking. And what is becoming quite clear is that a third element is important, and that is about impact investing. What is your investment decision, or the investment decision you're taking on behalf of your clients, from an impact point of view, doing to society? whether it be an environmental or social issue. And I think we certainly, COVID has accelerated that and brought that far more front to mind in terms of the investment community, and I think it's here to stay. So certainly something from our point of view that is becoming more prevalent in our investment decision-taking process. So yeah, really putting that all together, some key points just to think about is, firstly, central banks are powerful. They're not able to cure the vaccine directly. They can't change human behavior directly, but through stimulating markets, they have the ability to create demand and hold prices strong. So we learned that lesson in 2009, and I think for the investment community, we were reminded of that again in 2020. The expectation from a market point of view is an accelerated economic growth. And we certainly think that is the common consensus, and we go along with it for 2021. And at the same time, the Fed and other major central banks have said to us that we're going to have a very accommodative environment in play. And when we say in play, we're talking about the short to medium term. So that is supportive of asset prices. And at the same time, sovereign bond yields are near zero, and in certain countries below zero. So it's forcing them as investors to look to other asset classes to achieve some form of return. So we talk about risking up. And then we touched on this, but really it's not our base case expectation, but probably the greatest risk to markets over the next couple of years will be inflation. So certainly something that we'll need to keep an eye on and be aware of. Some of the other themes that certainly will be prevalent during 2021 is that the dollar is likely to weaken through central bank intervention from the Fed's perspective. We could very well see emerging markets outperforming developed markets. As I mentioned, the dollar is counter-cyclical to emerging markets. Valuations are relatively more attractive in emerging markets. And also we expect higher commodity prices, which is an underpin for emerging markets. And then we've had a decade of outperformance by passive strategies. This may be the year where active management outperforms, simply because active managers are actually understanding the valuation of things they're buying and also the quality of the asset they're buying. So this may be the period for active management. And then, as I touched on, ESG is here to stay. So really what we're saying in one sentence is, as an investment community or people making investment decisions on behalf of clients, we need to be measured. There are certainly risks in the market, but there are equally reasons why asset prices can continue to perform because of the accommodative environment we're in. And with that, in all of our strategies, dependent on the mandate, we are deploying or employing a very measured approach between the asset classes.
All right, perfect. Thank you very much for that, Rob. I want to go to some questions that we've got from the audience. I was just looking. The first one is actually quite relevant because a lot of our clients are retired. They are trying to generate income, and the question is more about how do you find income in this very, very low yield environment? You spoke about government bonds with such low yields. Companies are cutting dividends. What do clients do that need that income and can't rely on this capital growth the whole time?
Yeah. So that's a very prevalent question for the markets right now, and a very hard one to answer, because as a base case, there is very little yield in the market. So some of the options for clients is, if we're going to stay within the fixed income asset class, you'll need to risk up. So look at either increasing your duration of your debt or looking towards investment grade or even high yielding debt. The challenge there is that even within those sub-asset classes, the credit spreads have narrowed, so the opportunity there is diminished somewhat. Outside of that, you need to look at other asset classes, so either looking to up risk towards equities or alternative asset classes is certainly an approach that we're adopting. Within alternative asset classes, the likes of, for example, structured products are something to consider as a potential pickup in yield. But like all investing, the principles remain the same, remain diversified. You certainly don't want to be positioned in one single asset class in this type of environment, which kind of ties up with that measured approach that we mentioned.
Okay, thank you. Another question is just talking about diversification. We all say how key it is, but within equities, how do you diversify within that particular asset class?
Yeah. So there's some broad opportunities within equities. The starting point is from a regional point of view, so you can obviously look at developed markets and emerging markets, and within that there's another subsector. So even within emerging markets, you've got Eastern Europe, you've got Asia, you've got Africa. the like. So you really need to unpack within emerging markets what exposure you're having. And then similarly, you're also able to diversify between the sectors. So the combination between energy stocks, for example, financial stocks, technology stocks. And then the third dimension to also consider is between the factors. So there are many factors, but some of the more broad factors are value and growth investing, and understanding that you have a healthy contribution to, for example, some growth exposure, some value exposure within your overall portfolio construction. So the short answer is how you unpack that is in various ways, essentially.
Okay, I'm smiling because the next question is something that I've been fascinated with, and this is GameStop and short squeezes. If you can explain that to the audience, the question is also is it going to have an impact, a broader impact across the markets?
Yes, I think quite fascinating what's really happened in the last couple of weeks. So before I answer GameStop and what's happened there, we need to take a step back and understand what shorting the market means. So shorting the market essentially means that you go to someone and you borrow the stock from them, so typically a bank, with the understanding that you return that stock to them in a future date. And at that same point in time, you sell that stock today to someone in the market with the expectation that the price of that stock is going to go down. So if the stock today is $100, you borrow it from someone with agreement to pay it in the future. The price, you sell it on at $100, the price goes down to $50. At that point in time, you buy it in the market for $50 with the money that you have, and you return that stock back to whoever you borrowed it from, i.e. you profit $50. So, and that's typically the types of strategies that hedge funds employ. It creates good market discipline and just keeps the market in terms of pricing healthy. What has happened with GameStop is that a coordinated bunch of investors, which we refer to as pajama investors or really smaller retail investors, coordinated a group buying of GameStop. Now, GameStop, if you would argue, is in its twilight years. It's really it's a bricks and mortar store where you can buy gaming and electronic devices. So as we know, the world has moved on a little bit from that, and the hedge funds would generally short that position. This coordinated group of pajama investors bought a lot of stock through collective buying, which we talk about a short squeeze. The people who were shorting the stock are now forced to buy back their stock along with these retail investors also buying it, which creates like almost an elastic band snapping, and the price has gone from $4 odd to at a high of $400 in a very, very short period of time. So you asked me, what do I think? It's certainly quite dangerous. It asks a lot of questions about markets. Is that market manipulation? Is it insider trading? Is it public information? And what we saw on Friday night is the US regulators saying that they're going to investigate this and understand what the impact of the markets are.
Okay, yeah, fascinating to see how that unravels. And then another question on the Rand. No webinar would be complete with asking you your view on the Rand, please.
Yeah, so there's sort of push-pull factors for the Rand. So, and we must always remember that the macro factors are always what leads the Rand. And from a macro point of view, we are an emerging market, and there are some favorable tailwinds for emerging markets in the medium term, which has partly been why we've seen some Rand strength in recent months. At the same token, we also need to understand that our bond market, in terms of the yields you're able to buy our bonds at, less inflation, screens probably one of the most attractive in the world right now. So anyone in the search for yield, which is so hard to come by, would be immediately attracted to our bond market, and inadvertently, when you're buying a bond, you need Rands to transact that. So that's been the underpin for the Rand from a macro point of view, and for now seems to be winning the race. The micro, we know the challenges in South Africa are vast. We have some significant debt issues that we're dealing with. We have a structurally weak economy from a growth perspective, and then further hampered by the likes of Eskom. So our sense is that long term, and certainly that inflation differential has played out, the Rand should continue to weaken. But don't be surprised in the short end that the Rand does remain strong, or a little bit stronger than it is. But however, we are long-term investors, so we've set our ranges between 15 to 16. Anywhere within that we think is an opportune level for clients looking to have a long-term view and externalize money abroad.
Okay, thank you. Next question is, when do you think that the US will increase interest rates? I know you touched earlier on the inflation rate has to be 2%, unemployment rate has to be 4%. But if you had to take a take a stab at when they will actually start increasing?
I think later than we all expect, in a simple term. So we have to go with what the Fed have told us. They're guiding us in that regard. And based on their sort of expectations, my sense would be sort of we're at least 3 years out before they would consider hiking interest rates.
Yeah, because that could be the shock, another tantrum potentially when people start seeing rates increase. So something definitely to watch, and something that I know that you do watch on a daily basis. So I think we need to leave it there for today. Rob, thanks again for your time. Always a pleasure having you on these webinars. And thank you to everyone for joining. I've personally come to expect the unexpected, and every crisis has further reinforced my belief that when investing, you do need a diversified portfolio. You do need to have a long-term outlook. If you have any questions, if you want to reach out to us to look at any of your financial planning, any of your wealth management, please reach out to your advisor at Carrick or email us at wealthmanagement@carrick-wealth.com. Otherwise, be safe, be happy, and be good. Thank you very much.
Thank you.